After yesterday's focus on inflation and monetary policy, today our focus moves fairly and squarely onto the US and China challenge, the tussle between these two superpowers. I'm going to kick things off, in essence provide a bridge between these 2 days by working through Franklin Templeton Investment Solutions long-term as well as short-term expectations for various emerging market and developed market asset classes, and then share a lot more about our outlook definitely in the short term. So we go through a process every year of trying to evaluate what we think the 10-year return out of various asset classes looks like. We are informed by a blend of objective inputs, a lot of quantitative analysis and fundamental research. And what you see on the screen right now are our 2021 capital markets expectations. For global equities, a little around 5.5%. For global bonds, actually less than 1%. And these are our 10-year expected returns. Now, obviously they're low. They're certainly a lot lower than history. And that reflects a few important aspects. One, the low starting level of interest rates and expectations for some normalizations, the very compressed term premium, for example. And it also reflects, certainly on the riskier assets, that valuations are toward higher levels of historical experience. So very definitely a preference for equities, but returns are very modest, unfortunately. When we start thinking about the shorter term, we're actually more optimistic about equities. So tactically, we are wanting to be overweight equities, and that's certainly been a position we've had in portfolios for over a year. What's driving that? Continued strong global growth as different areas of the economy, of the world economy, come out of COVID. Higher inflation, which while we notice as a threat, we still do expect will abate predominantly in 2022. And then a pace of adjustment from central banks that is likely to surprise with how dovish and how patient it is. So let's break down equities and talk about our long and short-term expectations for different regions. So the EMs, China, and then EMX China on the right-hand side of that slide. And you can see that those numbers are actually pretty good, right? So somewhere in the low sevens for both parts of the emerging market complex. If you compare that against the US, really a low fives, Europe ex-US a little bit higher, Japan just under 5%. So a clear benefit when investing with a 10-year horizon of allocating with a skew towards emerging markets. The situation, however, is totally reversed when we look at things from a 12-month tactical perspective. And as asset allocators, as active asset allocators, that's our key time frame. So what's driving those differences? Firstly, the exit from COVID, far more entrenched in DMs. While EMs, if you're China, you've actually come out of COVID, but then you're still kind of running this zero tolerance, which is stopping that full resumption of travel, for example. And if you're other EMs, your vaccination process, by and large, is either less effective, lagged, etc. So you're yet to reap that benefit of full reopening. Monetary stimulus is very important. So monetary stimulus is far greater in DMs, and we'll talk through that shortly. EMs have responded to higher inflation already with rate hikes. Brazil, Russia, Mexico, Korea as examples. And China, while China did tighten earlier this year, is only just starting to gradually take its foot off the brakes. So, for us, that policy support is going to be so much richer in 2022 for DMs. And of course, regulatory risks, they remain an issue. That's going to be something our experts are going to be talking about in great detail as today goes on. Looking briefly at our expectations long-term for the various government sectors and various emerging market as well as developed market spread sectors. And it was really interesting to kind of see, Yeah, there's not a lot of value in developed market government bonds. Yep, there are a couple of opportunities, emerging market local, high yield has some opportunity, and frankly, that is very consistent with how we're thinking. This is a unique environment for the investment in government debt. When we think about the next 10 years, we think investing in US government bonds, European government bonds hedged to US dollars, or JGBs hedged to US dollars, that's going to disappoint you. That's going to give you a sub 1% nominal return. That's going to very definitely give you a negative real return. Where we do see better opportunities is emerging market local government bonds, Chinese government bonds, and we see modest opportunities as well in spread sectors. In terms of how we're thinking this year, so more tactically, much the same. A few interesting and important elements of difference. We're actually looking for negative returns out of US government bonds, as we do expect yields to move up meaningfully, but not super meaningfully. That is going to weigh on global investment grade. That is going to weigh to some degree on high yield. But that, for us is perhaps going to see lower levels of return in those areas. Where we are going to see better returns, we're actually quite positive on Chinese government bonds. We feel the slower growth environment will see incremental easing and liquidity support as 2020 goes on. And then that certainly would agree with some of our fixed income CIOs that there are opportunities, selective opportunities in emerging market local debt. So how are we at Franklin Templeton Investment Solutions playing these views in our portfolios? And the two charts here summarize our positioning with regards to equities and our positioning with regards to fixed income across our portfolios through the notion of a policy portfolio. We've been looking at the top chart and the dark blue line. We have been overweight equities since November of 2020, and we maintain a substantial 5% overweight to equities. It's important to look at where that overweight comes from. And the green line shows that basically the majority of our overweight has been in the United States. We've tended to have a little bit more variation in terms of our EM and our European positioning. Earlier in 2021, when China was still enjoying that upswing, we were overweight. And then you've seen, and this is looking at the light blue line, you've seen us actually move underweight China and emerging markets. Whereas Europe, once the Europe reopening took place, we were able to allocate and become more constructive there. The flip side is obviously fixed income. So underweight fixed income since November 2021. The dark blue line gives you the indication of the magnitude, and that's against the left-hand axis. And really, our underweight is split in government as well as in credit sectors. Another way to look at things is in duration. So looking at the dashed gray line at the bottom and looking at the right-hand side axis, we've been running a duration underweight of pretty much 3/4 of a year for much of the last 12 months. Interestingly, behind that is a underweight to DMs, typically around a year, offset by an overweight to emerging markets, namely Chinese government bonds of around 1/4 of a year. So shifting gears and kind of talking about really zeroing in on 2022 and where we see the key drivers of relative performance across these asset classes. So first and foremost, we expect continued strong global growth. Yes, the pace has peaked, but the rush to the trough is not particularly quick. So IMF kind of expect around 6% GDP for the world in 2021, stepping down to just under 5 in 2022. That is still very robust, very above trend levels of growth. Now, where is that coming from? That is expected to come from developed markets. That's expected to come from countries like the UK, where the expectation, just looking at the left-hand side chart, is for growth to exceed trend by 4%. The US to exceed trend by 2.5%. Japan even to exceed trend by 2%. Where isn't the above trend growth coming from the emerging markets. EMs ex-China are very mild, 0.5% above expectation. China expected to deliver below trend, and certainly our fixed income and our equity panels yesterday, there was almost a unanimity in thinking that Chinese growth with a low 5 handle, perhaps lower, is where we could be heading for 2022. That's really important when we think about the speed of output gaps. So, China, so on the right-hand side where you see that vertical line, that's where we are now. The horizontal line is having a positive output gap, and then below is a actual output gap that you want to close. China has closed that. That's the blue line right up top. The gray line is the US, and the US will close that output gap over the course of this year. And that's something that's important to note. Other countries are going to be 1 to 2 years, and looking at the orange line, that's actually emerging markets. And you can see emerging markets ex-China, and you can see that it's going to be a slower path to close that output gap. Another reason why we are favoring developed markets. Liquidity and policy, very, very important. It's important to note, as much as the Fed has now announced and will commence tapering, that still means buying more and more bonds until that taper ends, right? And you can also see, if you look at the left-hand side chart, and it's the PBOC, so China, it's just basically central bank assets. China has already started to see, just towards the bottom right of that chart, a reduction in its balance sheet, whereas the ECB, that light green, continuing to rise, and grey, the Fed, continuing to rise. So liquidity is definitely, again, supporting the developed markets. Real policy rates, crucial. When you look at the real policy rates right now, they are far more stimulatory in the developed markets. In the UK, 2%. In the Eurozone, 2% negative. China has got a perfectly fair and reasonable real policy rate of about 75 basis points. By the way, that's a great investment. That's one of the reasons why, that's one of the attractions to us that we have towards investing in Chinese fixed income. But with such low negative real rates, that's also a very strong incentive to move towards more risky asset classes within developed markets. Inflation, clearly something that can upset the apple cart. A lot of conversation yesterday on inflation. I'm not going to add too much on it, other than to say there is very clear evidence that the recovery in demand that happened as COVID became more manageable happened at a much greater pace than that of supply. And we have a few charts here from the Federal Reserve of San Francisco, which we do find quite helpful. So they've split and identified COVID-sensitive elements of core PCE inflation and looked at their contribution. They've looked at ones that are COVID-sensitive and impact on demand, and ones that impact on supply. And you can see on that left-hand side chart towards the right, it's really been this surge in terms of COVID-sensitive demand that has had a very large impact on inflation. On the right-hand side, they split out inflation into areas that are cyclical and some that are acyclical. Cyclical is basically referring to the overall economic environment, whereas acyclical is referring to within specific industries. So when there is a supply shortage within specific industries, you're going to see that impact on that green line. And of course, it is that green line. So we are of the view that inflation will moderate as some of these imbalances are addressed. But what is critical and what we are very focused on is behaviors, and whether or not we see entrenched behaviors as a consequence of this. Whether or not we see inflation expectations rise, they have risen, but they're not at levels that are totally concerning. But it would be very, very important. I think throughout 2022, we're going to be focused on, is there an unanchoring of inflation expectations? Is the US as good as it gets? Sounds pretty good, right? Valuations by most measures are elevated versus history and against the rest of the world. One, interest rates have never been lower, and lower interest rates tend to be associated with higher multiples. Also, that the nature of the US equity market is now one where there are greater sectoral exposures to sectors that tend to have higher multiples. We definitely agree with that, but we also do feel that there is scope, just because of the earnings growth potential that remains, as the economy is expanding. There is scope for equities to continue to rally because there is sufficient earnings growth. At the same time, multiples can contract a little bit. So we're actually looking for multiples to normalize to a degree, and that would show up in that chart as a negative kind of turquoise color. And we expect earnings, which is more that brighter blue, to be the part that adds to the overall return of equities. So the dark blue there is the annual return on equities, and that is a function of three things: the dividend yield in orange, the green that is the change in PE, and the blue that is the change in EPS. So, there's also other sources of upside, right? So Biden's Build Back Better, Infrastructure Act and Jobs Act have the potential to increase growth further, 1% plus per annum, several years. And the corporate tax reform agenda has been watered down quite a bit. We can see in terms of what's still there, that's a 2% hit to earnings or thereabouts. Far more easier to handle. Switch gears, China. So why are we cautious on China? 4 main reasons. Firstly, China's not experiencing the COVID reopening dividend, right? That's a big factor everywhere else. That's going to be a big factor in other countries, but China seems to be not in a hurry to kind of embrace that now. Slowing growth, and very definitely this focus on deleveraging. And so to kind of look at a couple of these charts here, on the left-hand side, you've got the Chinese credit impulse. It's a very good indicator of the ups and downs, the peaks and troughs in growth. If it rolls over, you're probably approaching a peak in growth. And we have seen, after stimulus in early 2020, we have seen tightening that has caused that to roll over and seems to be heading lower even still now. Now we are of the view that we're at levels where in the next 6 months, hopefully sometime in 2022, we are seeing signs of a bottom. But the question is, will they allow it to rise quickly? And our view is they won't, because if you look on the right-hand side and you look at the growth in credit to non-financial sectors, China's had that large leveraging phase. They are looking to deleverage, and so they'll be very cautious around how much they stimulate here. The other reasons to be careful, to be cautious about China: trade disputes remain unresolved in the longer term. They're symptoms of a broader tension, the geopolitical concerns that we're going to spend a lot of time talking about today. Together with the regulatory risks, and I don't have a firm view as to whether or not they intensify or get better, but I do know that there is a risk premium that needs to be in markets to reflect that potential. So this does not mean that we're core negative on China. As I mentioned, we've got a pretty positive overall 10-year view. It's about looking for opportunities, and I think there may be some great opportunities as this year goes along, as we start to see that credit impulse actually start to pick up. So I'm going to finish just kind of sharing a couple of key points here. We prefer to remain overweight equities. We expect risk to outperform. Our favored geographies, the US and Japan, cautious on EM and China. Within fixed income, we're underweight duration. We're expecting developed market bond yields to rise. But more constructive on EM, particularly Chinese government bonds. And as the year progresses, we hope to see an environment which enables us to actually rotate more favorably into EM. Thank you, and I'll welcome any questions.